I've got a couple of companies yet to go over, and I know it's kind of late, and I apologize for you that were saved for last, but hopefully you've gotten something out of the other ones, and we can tidy up any things that, important things that maybe you missed. Two that I have left are PepsiCo and Starbucks, two really outstanding companies. PepsiCo obviously has been around forever, and has competed well. And Starbucks, a little newer company, although it's been around for 20, 30 years now, and has really been an unbelievable growth story, and remains so. Um, I remember years ago, actually, I taught a personal finance class, and at that time we took a look at Starbucks for whatever reason. And gosh, I should have invested some in that at the time, and looking back, I should have, and I never did, and shame on me. But let's talk about Pepsi first, and I'll send out one a little bit later, looking at Starbucks. So, again, I like to look at this first page oftentimes, just see if some things jump out at me. I'm not terribly concerned about the price or the range. It looks like it's at the top of the range for the last bit. It's got a yield of 2.74%. That's got to be on its dividend. That's a nice yield. When you think about right now that your savings account is paying you 0.1%, which is virtually nothing, right? You can invest in Pepsi, which is a strong company. It's rated AA minus, which is a very strong rating still. In fact, there's only two companies I heard remaining with AAA ratings, and that's Microsoft and J&J. Okay, isn't that amazing? Out of all the companies, and in fact, the United States government is not rated AAA, just those two companies. So, nice yield anyhow. Market cap, big company, right? $148 billion in market cap. So, big company. And we come down and take a look at it, kind of looking at this stuff, interesting. I do see that we've had some concerns with revenue growth, both in the industry and for Pepsi as well. It's actually done a little better in that its revenue has not declined as much as the industry, and likewise with income. Operating margins. Look at that ROE though. That's a heck of an ROE, and we'll talk a little bit about where that comes from. And debt to equity, a leveraged company. It looks like 2.8 debt, 2.8 times as much debt as equity, which we would see probably down here, right? I mean, here's the total liabilities. Here's the total stockholders' equity. Looks even more than 2.8 actually. So I'm not sure when that statistic was from, but that's about 4-to-1 debt to total equity. So right here would be about 2.5-to-1 or 2.8, because that's about 3. Yeah. So they might have taken it from the 2014 year end. But at a quick glance here at Pepsi, and it's one thing that I think I'm going to need whoever's doing Pepsi to concentrate on a little bit is, revenue. Okay, let's look at the income statement. We see revenues declined. We saw that up above. We see operating incomes declined and net incomes declined. So we're in an industry that's definitely mature, definitely on the downhill slide maybe. And keep in mind that tobacco, for example, has been in that mode for the last 20 years. But had you owned tobacco stocks, you'd actually done fairly well. Because they've paid a huge dividend, they're returning a lot of cash, etc. So earnings per share also a decrease, and that concerns me a little bit with what I'm going to see and say a little bit later, because it may dispel a notion that I had at first. But we look at the balance sheet, current assets about the same, non-current assets have decreased some, not really a surprise. So total assets have decreased. At the same time, current liabilities have stayed the same, but total liabilities have increased, $4 billion, and assets have decreased by $8 billion, and that leads us to here. Total shareholders' equity has actually decreased from $24 billion down to $12 billion, so it's cut in half. Okay, normally I would have said then that meant that they've probably been buying back a lot of shares, and my guess is they've bought back some, but you sure don't see that in the earnings per share. Their operating income's down, but their earnings per share is down a commensurate amount, so I'm not so sure that they're buying back a lot of stock, and yet the shareholders' equity's been decreasing. So I gotta know why. Whoever's doing Pepsi, I gotta know why. What's the deal there? Why? have they made a strategic decision maybe? And we've seen that, maybe with some other companies that, interest rates are probably never going to be as low as they are right now, and it's not a bad time maybe to take on some debt. And so we might see some companies that are doing that. Okay, so quickly then let's go take a look at again the financials. And mainly I kind of want to look at, I've seen some of the basics there, but I do kind of want to look at what's been happening with its share base, right? Okay, I'm going to switch this to let's take a look at the percent view here. Yeah, pretty steady here in the gross profit, although actually, gross profits come up a couple percent, so that's pretty impressive. But total operating expenses have come up even a little bit more than that. So from 38 to 42, almost about 4% increase in operating expenses. So it's not running as efficiently as you would like to see, and it looks like this could be exceptional though. Okay, so that might be something to look at here for 2015. You look at other operating expenses have been, just small percentages, and here you've got a big increase too. So that may be an exceptional item here in 2015 that we need to take a look at. May have had you look at 2.27 or percent, which is 2% above normal. That would make a huge impact on Pepsi's income for the year. Interest expense, ooh, look at that. So that kind of confirms my notion that they're taking on some debt. Okay, income before taxes is decreased, not surprisingly, and so we've seen net income from continuing operations. Really, if we go back in a 5-year sense, it's only gone from 9.72 to 8.72, so 1%. It doesn't look quite as bad as if we go to here, right, where it's about 1.5%. Again, you're talking about huge numbers when you're talking about sales and whatnot with Pepsi, and so 1% or 2% is huge dollars. Okay, and here again, I wanted to look at what the shares outstanding are, and certainly they've bought back some stock, and so they've spent a decent, from 1.5 billion shares, it'd be my guess outstanding. Almost 1.6. I'm sorry, they're down to about 1.5. So they've bought back about 100 million shares. It looks like. Keep in mind their stock's at about $100 a share. So 100 million times 100 would be 1 billion. That's a lot of money. Then it looks like that it has spent on purchasing or buying back stock. Okay. Again, I would have thought that might have had a better impact on their earnings per share, but this right here, could be a key number, right? They've increased their gross profit nicely, but this 2% must be an extraordinary thing, right? Because their operating income would have been up to 15%, which would have been higher than any other year, okay, along there. And even though they've had reduced revenue and whatnot, so the dollar amount might not have been as high, but that's interesting. So figure out what that was in dollars. Again, we see a decrease in the last couple of years. And that's certainly I want you to talk about what's causing the decrease, the competitive nature of the business. I would think that what you're going to see is on the Pepsi side, competition, much like we're seeing with the big brewers, right? We're seeing other small companies come in with different beverages, not necessarily carbonated beverages like these, but sports beverages and things like that, and teas and other things that people are drinking, as opposed to the carbonated Pepsi, which has been the driving force behind Pepsi and Coke. But here, big amount there. They spent $1.4 billion on something, and that made these results a little bit odd, and so we need to know what that is. We need to hear about their plan, what they've done, to set aside money to buy back stock, and what they plan to continue to do. And at the same time, they're paying a pretty nice dividend. Okay. Take a quick look at the balance sheet, because wasn't there something on there? Yeah. We saw that the decrease in the equity, and that certainly has something to do with buying back the stock. So when you buy back the stock, you're reducing cash, reducing assets. Okay. You may or may not be using debt. It looks like they've actually used some debt. Okay. Cash has gone up. Okay, so they're doing a great job of cash, of accumulating and keeping cash, and their current assets have gone up. Net plant and property's actually gone down, so they're converting assets, or basically, you get this accumulated depreciation. It looks like is what's causing a decrease, mainly the decrease in the net property and whatnot. But a big uptick in cash, and at the same time, it looks like I got to look at their long-term debt. Yeah, from 20 billion up to 29 billion. Okay, so a big increase in long-term debt. At the same time, their current liabilities have actually decreased, and so this could be plain and simple a decision by the company, by management, to pursue long-term debt, to fund some things into the future, simply because rates are good and low. Okay, they built up equity through here, and then they've given it back quite a bit, and you'll see that. Look at the treasury stock. When this is a negative, it means that they're buying back, and so that's $8 billion, right? It looks like that they've spent in buybacks for the last couple of years, and that's a good share of this reduction in equity. Okay, and so that's that would be a good share of it, and something certainly that needs to be discussed more in terms of what management's plans and whatnot might be, for that. So they've given back a lot, and if they're paying a 2.75% dividend, which they are, my guess is 2. Then that's limited how much gets retained for earnings. And I just kind of wanted to look at their dividend here, and you should spend a little more time looking at this. Obviously, here's their debt issues. Yeah, look at that, from 4 billion up to 11 billion. So pretty amazing. Yeah, dividend paid. So they've just paid out a nice, it looks like, even a growing dividend. Each and every year it's growing a little bit. As a shareholder, that would be kind of nice. Okay, and they've bought back a lot of stock, which also as a shareholder would be common stock repurchases. Looks like they went along here at a reasonable amount. They bumped it up here in 2013, 2014, 2015, and the trailing 12 months. So I wouldn't doubt, they may do even more here in 2016. But nice bump up there, plus an increase in dividends all along. So put that together, that's kind of been responsible for the decrease in the equity. So I wonder if that's something that they plan to continue, if they want to keep decreasing equity through the upcoming years. I don't know. Interesting. So I'll be anxious to see what you find out. Thanks, and have a great day.